On January 2nd, 2025, I put out a video with my top 20 stocks for the year. This is that entire list. I shared this image in that video. Here's the actual returns in 2025 of those stocks. You can see on the left, a lot of the technology companies, artificial intelligence, autonomous driving did extremely well. Growth companies did really well. Energy, not so much. But in total, the average return of those stocks was 38.9% in 2025. So I'm back. It is 2026. Getting a little bit later start, but we're going to go through the top 20 stocks that I have for 2025. A lot of these stocks are in the asymmetric portfolio. I'm going to put a timestamp on each of these in the timeline below. So if you want to skip forward to any of these, my analysis on each one of these stocks is going to be a little bit longer than a normal video, but I want to go through each one of these companies and why I'm excited about them in 2026. Like I said, own a lot of these. I even recently bought more of some of these stocks for my buys for asymmetric investing at the beginning of January, but there's some new ones here as well that I'm exploring and may add to the portfolio throughout the year. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. If you want more from me, check out my Asymmetric Investing newsletter. There's a link on the screen and a link in the show notes. That's where you can get all my research. So if you like what you see here, I think you're going to love that newsletter. Let's dive into these stocks, and let's start with number one. That is Alphabet. Now, one of the big changes for this year is Alphabet's the only AI-related stock that I have. There's a few reasons for that. One is that I'm really worried about the OpenAI infrastructure companies. So everything from NVIDIA to Oracle, the Neo clouds, OpenAI just fundamentally doesn't have a sustainable business model. Their entire business today is reliant on them being able to raise more money. I think it's $131 billion that they're expecting to burn through 2029. I don't see that being sustainable. And you look at over the past 6 months, Gemini is gaining significant market share. That means that Google and Alphabet becoming stronger. That's why you see this right here. This is since April. Stock is up 108%. So just phenomenal returns. And the real reason is their fundamentals are starting to show exactly how powerful this business is. This is just the Google Cloud revenue, compound annual growth rate since 2017 of 30%. But look at this, since 2021, that growth actually goes up to 31%. I'll add in operating profit here, and you can see that just in the past couple of years, Google Cloud has become operating profit positive. Now those margins ticking up closer to 20%. That could be 30% in the future. This is one of the phenomenal businesses within Alphabet. And I want to highlight where Alphabet gets its strength from, because yes, search is the biggest business. That's what you're going to see here in blue. That's where they get a vast majority of their revenue. I don't think search is going anywhere. I think they've done a really phenomenal job transitioning search into this AI mode. You're able to pull in those artificial intelligence tools when you want them in a familiar product, but it's really all about distribution. The most commonly used browser in the world is Chrome. Chrome is made by Google. The most commonly used mobile operating system is Android. Android is made by Google. So they are really the gateway to technology and artificial intelligence. That's starting to show itself with the gains in Gemini. And we're seeing that there's growth in search. There's also growth in YouTube ads, also YouTube Premium, which is going to fall in this next section, which is subscriptions, platforms, and devices. You add all three of those together, and then you also have the investment arm. They have a VC arm that's invested in companies like SpaceX, has somewhere around $100 billion stake in SpaceX, Anthropic, Stripe, all kinds of companies provide more value there. That's on top of the cash. It's already on the balance sheet. We know that Google has the money and is going to spend the money to be a leader in artificial intelligence models. They have the distribution. I just don't see how this is going to be a loser in AI. And in 2026, if they continue to gain market share, that's going to be to their advantage. It's going to be to the detriment to a lot of other companies. That's why this is the only company that I have that's really an AI focus, because I think a lot of these other hyped companies are just going to have a really tough year. Now, the next three I'm going to put in a bucket: Lyft, Uber, and Mobileye. These really go down to how I think autonomous driving is going to play out. For years, a lot of people in the market have thought that Tesla was going to take this market. There was going to be a winner-take-all market. I don't think that's going to be the case. I think this is going to be a very highly supplied market with dozens of suppliers. You not only have Waymo in the market, you have May Mobility, WeRide, AV Ride, Mobileye is working with Volkswagen. There's tons of companies that are trying to get into autonomous driving, because if you're an automaker and you don't have an autonomous driving strategy, you're in serious trouble. Who does that benefit? That benefits the companies that already have demand for rides. Companies like Lyft and Uber. So let's start with Lyft. Lyft was one of my top stocks going into 2025. You can see 5-year chart not looking very good, but the 1-year chart does look pretty phenomenal. You can see it's a 34% gain for the stock, so about doubling the performance of the market. Was a little bit higher there earlier in the year. Market cap still just $7.9 billion, but keep in mind they have a really good balance sheet, so their enterprise value just $7.2 billion. Enterprise value to sales just 1.2. Uber typically trades for 3 or 4 times that, so I'll get to that in just a second. Price to free cash flow is just 7.7. You can see why I think Lyft is a compelling business if they're able to maintain that number 2 position in the market. And things are going pretty well for Lyft. This is not going to be a company that's going to knock your socks off with growth, at least until we get to the point that autonomous vehicles provide more of their supply. But total revenue, compound annual growth rate, 22%. Operating income now moving to a profit, so was losing money. Positive free cash flow, but when you take out non-cash costs like stock-based compensation, they were reporting an operating loss. That's now moving to a profit. And I think the real thing for Lyft is that they have a real clear strategy in autonomy. Now, I want to highlight this is all coming from Fiscal AI. If you're interested in checking out Fiscal AI for yourself, you can get 2 weeks for free and then get 15% off with my link below, fiscal.ai/ASYM. One of the really awesome things is all these investor relations slides are right in the platform. So I can just go full screen here and show you exactly what their strategy is, how they see this industry playing out. This is going to play into both Lyft and then Mobileye, who you see right here. So there's the technology providers, the vehicle manufacturers. Then you have who's going to actually own and finance the vehicles, who's going to manage the vehicles. And then you have what's the mobility platform and marketplace. So that's one of the things that Uber and Lyft does in the background. So they're creating this marketplace for rides. And then what's the rider demand experience? So today, this would be the app that you and I interact with. And this would be the platform that the drivers are interacting with. But when you move to autonomy, it looks a little bit more like this. That's the way that they are pitching things. Uber sees things very similar. Now, the advantage for Lyft here is if you maintain this demand side, then you have all the demand and then you just need to pull supply into the market. So that's what all these companies are here. These are all companies that they're working with to make autonomous technology, to build vehicles, to finance them, and then also do fleet management. That's one of the things that they're able to do with FlexDrive, which is something that they own. The other thing that they did in 2025 is they bought FreeNow. That is a fleet company because they're working with taxi operators in Europe. Plug in autonomous vehicles instead of taxis, and now you have a clear strategy for growth, not only in the US, but also in Europe. Now you see why I think this is a company that trading for 7.7 times free cash flow, a 17% compound annual growth rate, really good value for investors. Uber has a very similar strategy, very similar upside in autonomy, but the difference is they're in the number 1 position instead of being in the number 2 position. So I own both of these stocks as basically a basket in autonomy. If I'm right, and the demand side of the business is really the most important point, that we really want to aggregate that demand, then both of these companies are going to be winners. Don't know which one's going to be the bigger winner, but I'm going to own both of them. Enterprise value to sales, I talked about that being a little over 1 for Lyft, 3.5 for Uber. They do have a little bit better margin, but their price to free cash flow is 20 times. So not the same valuation that you get with Lyft. The nice thing you do get with Uber is more diversification. So this is their mobility revenue in blue, their delivery revenue. So this is going to be primarily food delivery in orange, and then their freight revenue in purple. You can see that each one of these segments is growing over time, but it is a much more diverse business than you get with Lyft. That is almost entirely just moving people around. So the mobility business. Now they potentially have the opportunity to move into other areas of the market, but Uber already there and already the number 1 position. So that really puts them in a nice spot as they plug in more autonomous vehicles. And Uber and Lyft have a very similar strategy in autonomy, 20 partners across mobility, delivery, and freight. They want to have as much supply as possible on the Uber platform. That commoditizes your supply. That makes you, as the demand aggregator, the most valuable point in the value chain. So if we do get to the point with autonomy, where there's a ton of suppliers in the market, where these demand aggregators are a real point of value, where else is there going to be value? If we're not going to have a one-size-fits-all winner like Tesla in the market, or like even a Waymo. And by the way, I own Waymo through owning shares of Google. Well, then the other logical place to add value would be to be a modular supplier for technology. Being a company like Mobileye, who can say, you know what, I will sell you autonomous technology, I will sell you chips, I will sell you other pieces of hardware like imaging radar. That's exactly what they're doing for OEMs. Now, the stock has not performed well recently, just an $8.3 billion market cap. But look at this. Phenomenal balance sheet because the enterprise value is just $6.6 billion. This is despite actually having a pretty good trading day today. Now, Mobileye has struggled recently. You can see that revenue just kind of bumping along, not a lot of growth. They're not having a lot of increased volumes. I'll get to how much they're actually making on each of these systems and how much they're selling. They also had a huge write-off. That came in last year, and they have lost money on a net income basis. Now, if we pull in, go to free cash flow here, we can add free cash flow, and they are free cash flow positive. But let's go down here to segments and KPIs. And this is one of the really great things with Fiscal AI. You get all this detailed information. One of the things I like to look at is the number of systems shipped and also the average system price. So both of these numbers are things you're going to be able to track over time. The number of systems shipped per quarter, you're at 8-9 million units shipped per quarter. So what that does is if you spend $1 billion developing a system or developing a chip, think about a company like Rivian or Tesla. Now, instead of dividing that just simply by the number of vehicles that you're producing, so in Tesla's case, a little less than 2 million, Rivian's case, 45,000 per year. So instead of dividing those development costs by that number of units you can actually produce, you're dividing it by the number of units you're actually selling to multiple different OEMs. So not one OEM is buying 9 million units per quarter from Mobileye. There's multiple OEMs who are buying that many units. There are multiple OEMs who are driving this business. That's why you get announcements like you got today. This is before I started recording. They announced in Las Vegas. Their keynote presentation is coming up after I record here, but they announced that a US-based automaker has chosen Mobileye IQ6 High to power future advanced driver assist systems with hands-free driving on select highways across millions of vehicles worldwide. So millions of vehicles are going to get this chip. That development cost is going to be spread across all of those sales. This is a much more efficient way to get technology into more vehicles. OEMs, I think, are going to make more and more of these partnerships going forward, because if you look at companies like General Motors, Ford, Volkswagen, Daimler, some of the Indian manufacturers, these companies just haven't been able to develop their own technology and launch it at scale. GM has done actually a pretty good job. But most of those companies are going to lean on someone else to provide a lot of that technology. Mobileye becomes that company. They become a modular supplier in the supply chain. That gives them scale in their segment of the market. And as of right now, these Mobileye surround ADAS systems, they have future demand of 19 million units, including 9 million that were added today. So let's go back to this right here. So 9 million units per quarter, but those units are selling for just $50 per unit. So now you go to a more advanced system, more advanced chip, more sensors. That should increase the revenue per unit. Surround ADAS is not going to be going to $1,000 per unit, but some of their more advanced systems are. They're going to be significantly more expensive than that. Like the drive system is going to be potentially over $10,000, maybe even more than that. But that's the strategy for Mobileye going forward. And with just a $6.6 billion enterprise value, I think the asymmetric potential is really phenomenal for Mobileye. Every single OEM in the world is going to have to get into the autonomy business. This is the easiest way for them to do it, is partner with a trusted company like Mobileye. This is the biggest supplier for level 1 ADAS systems. That's just the front camera. You may have that in your vehicle today, so that's going to do things like allow you to do that smart follow, lane assist. That's going to allow you to do things like the smart follow feature or have lane assist, but that's just going to be one camera, one chip. This is going to be more sensors, more tech, a bigger model that's going to be running a more advanced chip that's going to increase that revenue and likely their margins per vehicle. That's why I like Mobileye. So in autonomy in general, I think Lyft, Uber, and Mobileye are the best positioned today, not some of the more expensive companies like Tesla and Rivian. On Holding has been one of my favorite stocks over the past year, and I recently really increased that position because I think this is an insane value given the growth the company has demonstrated. A lot of what you need to know is right here. Enterprise value to sales is 4.2. For context, Nike is trading for 2.1 times sales. So you're paying about double the price, but Nike's revenue is shrinking. On's revenue growing 40.1% over the past 3 years. On top of that, Nike's gross margins, 41%. On, 62%. So it's a faster growing business. It's a higher margin business. and there's really nothing indicating that On is going to be slowing down anytime soon. You can see the phenomenal operating leverage that they have in the business. In blue is their revenue. Gross profit is in orange, and then operating profit is in purple. Now, I want to highlight it's very difficult for a company that's making a hard good like shoes, like apparel, to be able to grow this quickly and grow operating profit. You have to spend ahead of your growth. You have to spend on things like sales and marketing. You have to spend on building out inventory. A lot of that is very costly, and usually the operating profit lags the revenue growth that you have for the business, but On has been able to grow profitably because of those extremely high margins. Now, we've seen really strong growth in shoes, but still On has only about a tenth of the shoe sales that Nike has. So just put some perspective in the size of the company and look at the size of their apparel and accessories business. Both of these businesses could grow double digits, 20, 30, 40% for the next 5 or 10 years, and just continue to compound and add to the business. I think there is so much opportunity for On to continue to grow. It's got an extremely strong brand. It's growing internationally, and it's growing in its core markets like North America. Now, one of the complicating factors, they do report in Swiss francs. So oftentimes you'll see some strange reactions around earnings, but those are usually buying opportunities because this is a compounding machine and one of the strongest companies in apparel today. Hims and Hers, even a bigger growth story. Compound annual growth rate is 71%, and that enterprise value to sales is even lower at 3.7%. Just a phenomenal growth story. I'll go to some of their more short-term concerns in just a second, but you can see that this is a company that has compounded revenue over the course of the last 5 years at 76% and done so at an extremely high margin, and even their operating margins are improving. So let's go to some of those financials. Here, what you're going to see is revenue in this gray color and then operating profit in blue. So they've been able to grow since 2018 at a compound annual basis of 92%, and their operating profit is improving. Management has said that they're going to be able to increase that operating profit 1 to 3 percentage points per year going forward. They're adding more specialties to the business, started with ED, then they got into things like hair loss. They added weight loss a couple of years ago. GLP-1s were their big growth moment in 2024. For end of the first quarter of 2025, those came off shortage. That's why you're going to see some volatility in their quarterly growth. That's hit them over the past couple of quarters. But their other businesses, their non-GLP-1 businesses, have continued to grow. And as they've adapted and they brought more solutions to the market, Hims and Hers is able to be that aggregator in the medical business. They're going to be able to offer more solutions. They're going to be able to do that 24/7 in a much easier way than the traditional doctor-pharmacy relationship that you have today. We're seeing that in weight loss. I think that's going to be a massive growth business for not only Hims and Hers, but a lot of these other companies. As the cost of each of these products come down, you democratize access. That is ultimately good for Hims and Hers. This year, we're going to see them move into things like longevity and peptides. That's a real opportunity for growth. That could be another one of these phenomenal growth moments. And remember, about 30% of their shares outstanding are sold short. So there could be a short squeeze in Hims and Hers' future. Zillow is another one of these aggregators. You're sensing a theme here in the kind of companies that I'm looking for. You want to own the companies that customers are choosing to interact with. That's going to bring supply to the market. And if they're able to commoditize that supply, that's the real power position in the market. I think that's exactly what Zillow is doing. They started with the residential housing business that has continued to grow faster than the housing market overall. That tells you that they're taking a little bit of market share. They have a little bit of pricing power, but the real opportunity here for them to grow beyond a $15 billion enterprise value is the growth that you see in mortgages, which is blue, and rentals. That's going to expand the addressable market. It's going to make Zillow the place to go, whether you're looking to rent a home or whether you're looking to buy a home. It's also bringing that supply along with it. That's been a huge beneficiary in the rentals business. But let me take away the residential business. That's going to be the traditional home sales business where most of the revenue is going to come from agents. But the real power is going to be if they become the aggregator in rentals. You can see that rentals have grown at a compound annual growth rate of 32% over the past 2 years. And this is really the power of Zillow. If they become the place you go to look for rentals, then they can become a platform because you're not only finding that rental there, you're scheduling a tour, you're potentially signing a lease, even paying for your rent on the Zillow platform. Then when you go to look to buy a home, where are you going to look to find a mortgage? Well, Zillow can do that as well. They're also building out the platform to be able to schedule tours, make an offer, and even do your closing on Zillow. That's how you become a platform company. And like I said, it starts with controlling the eyeballs in the business. They're aggregating that demand. That ultimately gives them the power. And just like Hims and Hers has a massive potential in the medical field, Zillow has massive potential in housing. Garmin was on my list last year. This is another stock that I like, recently added to the asymmetric portfolio. A little bit different story here, not quite as high growth at 12%, almost a $40 billion market cap and a price to earnings multiple of 25. So this isn't quite a value stock. It's not a high growth stock, but I think this is just a steady growth company because of the diversification of their business. What you can see here is in blue, fitness, orange is outdoor, and then you have aviation, marine, and the auto OEM business. Yes, did you know that they make infotainment systems and other products for auto manufacturers? Not a business that gets a lot of attention, but it's about a $670 million business for them. In total, $6.9 billion worth of revenue, and most of that is coming from watches in these two segments here. I think we're going to see expanded revenue in both of those segments in the future as you get more connectivity. So we're starting to see more LTE connections, more satellite connections. That's going to be subscription services that are going through Garmin because they're not going to be directly going through a provider like Verizon or AT&T. Garmin is actually going to be the one controlling that subscription. That gives them another revenue growth and high margin opportunity in the business. And remember, these watches are extremely popular and they're becoming popular for more and more people. Garmin is growing faster than the Apple Watch. And there's a reason for that. There's more options if you're looking at Garmin watches. And we saw recently with Strava that Garmin is really in the power position. Garmin changed the rules of their API, said, you know what, you need to tell if the data that you're putting on your site is coming from Garmin. We'll allow you to look at it, look at where you're running and things like that for free. But you need to say, hey, you know what, this came from a Garmin watch. Strava said, we don't want to do that. And users revolted. They said, hey, we will drop Strava before we drop Garmin. That's the power that they have in the market. This is a company that I think could continue to just compound revenue and earnings over time. Not the highest growth company, but it is an extremely strong company in the market. So if we do get some sort of discount in 2026, happy to buy more shares at a lower price. I've covered Duolingo a lot over the past couple of months on asymmetric investing. You can see stock has not gone anywhere now since 2024. It's actually down a little bit, but since its peak, shares are down about 70%. And now we're starting to get to a pretty good valuation because over that period of time, they have continued to grow. Price earnings multiple is just 22. Enterprise value to sales is 7.6. And all that despite the fact that they're growing revenue 42% over the past 3 years and 60% over the past 5 years. Let's look at those financials because this is what investors are concerned about, is that their financials are not going to be growing as much as they have in the last few years. But let's really break that down. You can see that the revenue has been growing consistently. Compound annual growth rate is 42% over the past 2 years or so. And operating leverage is starting to kick in the business as well, $106 million in operating profit over the past 12 months. But let's look at the trends from a user perspective, because that's ultimately what's going to drive the business. In yellow, what you have is the monthly active users. You can see that even in the most recent quarter, the monthly active users increased. But look at the daily active users. This is what I think is most impressive. The daily active users were up almost 3 million just in the most recent quarter. If you go back to a year ago, they're up about 13 million over the past year. And the number of paid subscribers is increasing over that period of time as well. But what management said is that they're going to be focusing more on user growth, so the monthly and daily active users in late 2025 and into 2026, and less on monetizing them more. That's what investors were a little bit concerned about. Is the revenue growth going to slow? Is it going to be 10% next year, 20% instead of 40%? That's why shares have been dropping. And I think the concern is just too far right now. There's also concern that they're going to be disrupted by artificial intelligence. I just don't see that. AI is something that's going to be very useful on a day-to-day basis. If you're maybe traveling one time and you need to have a single conversation with somebody. But if you go to a restaurant, the person that's going to be using Duolingo is the server. You're going to want to be able to have a conversation with that server in your native language. So for example, I traveled to Europe recently. Being a server in a lot of places in Europe requires that you're able to speak English because of travelers like myself. So those people are going to be using Duolingo rather than both of us having AirPods in, speaking our native languages, and then AI is doing translation. I just don't think that's going to be the future. The future is going to still be people learning things on digital platforms like Duolingo. They recently added math. They've added chess. I think we're going to get more modalities in 2026. That's going to expand the value of their subscription and draw more users to the platform. This is going to be much more of an education platform 5 or 10 years from now than it is just a language platform. Number 10 on the list is Owlet. Owlet is a company that I've had in the asymmetric portfolio for almost 2 years now, and the stock is finally going crazy. You can see that shares are down 88% since they went public, but the real change has happened in just the past year. You can see in April, we were looking at shares at $2.80. It's when I probably should have bought back then, but didn't add to my position because there was a lot of uncertainty about the company. But that is starting to turn around, and I just want to give some of the metrics. This is what we have today. This is going to change a little bit as they converted most of their warrants into shares. So we'll get a little bit more clarity about that capital structure over the next couple of quarters. That should be a good thing for the stock. I think that's part of the reason that you have the positive reaction that you see. But about a $500 million market cap or so, and the financials are starting to get better and better. What you're looking at here is their trailing 12-month revenue, gross profit, and operating profit. Let me just condense this a little bit to the September 2023 quarter. You can see here that the compound annual growth rate for revenue is about 50%. So there's this just steady revenue growth for Owlet, and these margins are continually getting better and better. Now, there's still more skill that they have to have in the business, but some of the positive signs that we've seen from Owlet recently is that we're starting to see hospitals be interested in prescribing these before mothers leave the hospital with their new child. This was really the upside potential for Owlet, is that you leave the hospital with an Owlet device just like you leave the hospital with a breast pump. That could be potentially a more efficient strategy, also a higher price product, because that prescription product is going to be somewhere around 50% more revenue to Owlet than the traditional product, even if it's the exact same product. You're also seeing more bundling with their monitor, moving into more international markets. I think there's a lot of potential for Owlet to grow, and this could be really the baby monitoring product of the future. You start with the sock, move into monitors. There's opportunities to do monitoring for expecting mothers, things like that as well. That was always the upside potential when Owlet came public. We're starting to at least see some of that growth optionality be an option for the company as they solidify their balance sheet. I think that will give investors a little bit more confidence in 2026, and shares should keep moving higher. One that I have not added to the asymmetric portfolio yet is the trade desk. You can see over the past 5 years, this is crazy. Shares are down 49%. That's despite the fact that over that period of time, the company has grown at a compound annual growth rate of 31%. Now, if the business comes under real pressure, that's going to be a real problem. But right now, forward price earnings multiple is 20. Enterprise value to sales multiple on a forward basis is 5.7. Price to free cash flow is about 21. So let's look at some of their financials. This is a look at their revenue in blue and operating profit in orange. Now, despite all the narratives and everything that you've probably heard about the trade desk being disrupted by companies like Amazon, what we actually see in the numbers is that they continue to grow quarter after quarter. Now, that rate of growth may be slowing in a little bit. I'll add that in here, 20% over the past year. But this is still a growth company. And if they are able to turn things around in 2026, which I think is very possible, this is, again, a company that sits in a very valuable position in the market between companies that are trying to advertise and grow their businesses and the platforms that have advertising inventory. It's not a sure thing, but typically when you have stocks that react like this, when the fundamentals don't show the same weakness that you would expect, something is mismatched. And either the market is ahead of a really bad story or they're reading into something that isn't reality. Look at Alphabet stock a couple of years ago. They were supposed to be disrupted by artificial intelligence, but the numbers showed that they weren't actually being disrupted. I think that could be the case with the trade desk. That's why it's on my list, but it isn't quite yet in the asymmetric portfolio. Joby Aviation is one of my higher risk stocks in the asymmetric portfolio, but it's also been a really nice winner. Added it in the spring and shares just went crazy almost immediately. So since their lows in the $5 in April, shares have about tripled in value. Now a market cap of about $12 billion. They did recently raise about $1 billion. I think that was a good move because they do need to increase their runway to be able to increase manufacturing, get aircraft out into the field. But we should see Joby likely get their FAA approvals this year. They can probably start flying in places like the UAE earlier than that. But that's when you're going to start to see momentum. They bought Blade last year. That will bring more demand onto the market. They also have the heliports or vertiports that they're going to be called with Joby aircraft. But they need to start producing those aircraft. They need to get them flying under FAA regulations. And once that happens, I think this is going to be a growth machine. And one of the things that they need to communicate with investors this year that I'm really looking forward to is what are their full economics going to be? What do the economics look like? If they're going to be selling an aircraft, what's the pricing going to look like? Is it going to be $2, $3, $4, $5 million per aircraft? What's the margin going to be? What about when they're using a financing partner, but then that aircraft is still going to be in their Joby Aviation fleet? And then what happens when they own the aircraft and the air taxi service is being run by Joby? That's really the three scenarios that you have for the business. But I think this is the best operator in the business today. Archer Aviation was one that was on my list in 2025. Did not perform nearly as well because I don't think they're nearly as focused. Joby is a company that's actually doing the thing. Archer Aviation is a company that's more focused on press releases and getting attention rather than getting aircraft in the air. Now, just a quick reminder, if you want more from me, check out Asymmetric Investing. There's a link on the screen and a link in the show notes. That's where you're going to get my market-beating portfolio. Premium subscribers get that. I tell you every stock I'm going to buy before I buy it, and I buy those stocks once a month. So very simple way to build the portfolio, doing all of this in public on Asymmetric Investing. Check it out. The next few stocks are going to be very unloved companies in the market, but I like them for one reason or another. MGM Resorts is one that I think is very underestimated, about a $10 billion market cap. Their enterprise value to EBITDA, just 17 right now. Few things that they have going for them. So you have the baseline operations that I'll pull up in Las Vegas and Macau. And then they also have a big regional business. That's what you see in blue. And one of the narratives are that Las Vegas is in decline. That's not the case. Over the past year, Las Vegas gaming revenue is actually up slightly, but it is up. And you can see $8.5 billion in revenue from the Las Vegas Strip far outweighs what they were generating in 2019 before the pandemic. So this has long-term still been a growth business. But the real opportunity for MGM Resorts is two things. One, from a growth perspective, they're going to be opening their integrated resort in Japan in 2030. That could be the biggest and most profitable casino resort in the world. I think they could generate $2 to $3 billion in adjusted EBITDA or cash flow from that resort. They're going to own about 44% of that property. You also have momentum on the digital side for MGM Resorts. So BetMGM, which is a 50-50 partnership they have with Entain, expected to pay out about $100 million to MGM Resorts in 2025. And their other subsidiaries, which are operating in countries like Brazil, are expected to improve their financials, probably be positive free cash flow maybe in the next year or two as well. So potential growth in both of those segments. But one of the best reasons to own MGM Resorts is the fact that they're using their excess cash flow to just simply buy back shares. You can see the diluted weighted average shares outstanding down 11% since 2022. These buybacks have ebbed and flowed a little bit over the past couple of years. They do have obligations for that Japan resort. They have invested in some of their digital properties. But as we have more cash flow, particularly coming from Macau and the Las Vegas Strip, I think they're going to continue to do more and more of these buybacks as much as they possibly can. Maybe even take out debt to buy back shares at the cheap valuation that you have today. That's why I like MGM so much. I think this is much more stable and much more of a growth business that a lot of investors are giving it credit for. When that multiple expansion comes around, this is going to be a phenomenal performing stock. Disney is another unloved company by the market that I think the market is just getting wrong. About a $200 billion market cap, price earnings multiple, just 16, even 15 on a forward basis. And look, this business has really turned around. Look at how much revenue has improved and operating cash flow has improved since 2020. That was when stock was going crazy because everybody thought that people were going to be subscribing to Disney Plus. But the parks were really starting to struggle. That operating cash flow is now exploded to about $18 billion per year. And what's driving that growth? So far, it hasn't been sports. ESPN has really been in decline because they've been losing subscribers, even though they've been increasing prices. So you can see that revenue has been about flat, but entertainment has been doing really well. That is because their streaming services are doing extremely well. Disney Plus and Hulu are what's going to drive that. ESPN is going to fall in this orange bucket. But the experiences business has been doing phenomenally well. So $38 billion in revenue from the experiences business. Well, let's pull in the operating profit from experiences. This is what I think is so impressive, about $10 billion in operating profit coming from experiences. And that is only going to continue to grow as they expand some of their parks, as they have more cruise lines that are launching this year. And then throughout 2031, I think they're adding 5 or 6 cruise lines over that period of time. And we haven't seen a real impact from the ESPN app either. And ultimately, the goal for Disney is to be able to bundle Disney Plus for families, Hulu for general entertainment, and ESPN for sports. If you pull all three of those things together and you have one unified app, which they're getting closer and closer to actually having that be a really compelling experience, that's how you're going to build a huge streaming service. That's how you're going to be able to afford more sports content. I think this is a really well-positioned company. The movies are getting better. Disney had the only 3 films that generated over $1 billion in global box office. outside of China. There was one Chinese movie we don't have a lot of verified revenue about, but this is still the best studio in the business. It's the third biggest streaming service behind YouTube, the first stock that I covered, and Netflix. I think that's going to be a phenomenal position for Disney to be in long term. Airbnb, I may just be a sucker for this company, but I think this continues to be basically a verb in travel. Their financials are not nearly as bad as they seem. $71 billion enterprise value because they do have $80 billion worth of cash. Now remember, that cash that they have on the balance sheet and the cash that they collect in advance from customers is something they're able to generate interest revenue from. So that is not going to be as high if interest rates continue to fall on the short-term basis. But this is a company that a lot of investors don't realize is still growing. You can see here over the past year, the growth rate is in double digits, 10.2%. Net income is still really strong at $2.6 billion. They have tried to get into more markets. They're trying to move into things like experiences. I don't know if that's necessarily going to work, but that's optionality for Airbnb going forward. I think this continues to be a company that aggregates demand for at least a certain kind of travel. And if they're able to expand that into things like services, maybe hotels, maybe even air travel, that's where you get real optionality. It's a pretty good valuation for the stock. The price to free cash flow is about 17.6. On a forward basis, you get price to free cash flow of about 14. They are buying back shares. So if growth does pick up for Airbnb in 2026, could be a market outperformer. Bumble is again on the higher risk side. This is one I just started adding recently to the Asymmetric portfolio. Did a spotlight article on them late in 2025. But a few compelling things. Very small market cap, under $400 million today. The enterprise value to sales is only about 1. Now, the bad news is revenue is in decline. The good news is they've gotten much more efficient as a business, so their operating cash flow is holding up pretty well. Now, if their new strategy to basically go a little bit more high-end is going to be successful, they're going to have to change how people use the app. That's the real challenge here. Are they going to lose subscribers at a faster rate than they can gain high-intent subscribers? So the idea here is basically to reverse what happened between 2021 and 2024. You don't want to be lowering prices to attract subscribers because that actually dilutes the platform for everybody that's on it. So you have fewer high-intent people using a dating app. That makes it a poor experience for everybody. So if you actually have fewer users, but more of them are high-intent, that's what Bumble's strategy is. You're going to actually have a higher price point. That's why that's gone up to $28.3. We'll see if these trends continue. This is, again, a very high risk stock, but given the very small market cap, given the fact that the founder is actually back in charge, I think there's a very high possibility could be a turnaround. Not one that I'm going to be putting a big position in, maybe 1, 2, possibly 3% at most in the Asymmetric portfolio. But if they turn around, this is definitely a stock that can 10x over the next 10 years. Here's one that's going to surprise everybody. That is General Motors. General Motors is growing faster than Tesla. I'm going to say that again. General Motors revenue is growing faster than Tesla, and that is going to happen again in 2026. This is a phenomenal operating company trading for a price to earnings multiple on a forward basis of just 7. They had a lot of unknowns in 2025 because of tariffs. I think a lot of that is behind them and a lot of the other automakers. Some of the costs they had associated with regulatory credits are going to come off their books. That's going to make it more attractive to sell some of these big SUVs that are actually where they drive most of their profits. And their financials are really phenomenal. You can see that their revenue is growing. Let's look at operating profit for General Motors business. You can see just bumping along. $8.7 billion in 2016, $8.1 billion over the past 12 months. That's going to continue to improve in 2026 as some of their cost reduction measures that were announced last year are implemented more. And then you're also going to potentially have services revenue and subscription revenue from things like Super Cruise contributing more to the business as well. So more autonomy features are going to be coming to General Motors vehicles. This is just one of those companies that I think is always overlooked by the market. But if you look over the past 3 years, up 138%. This was a stock that was once in the Asymmetric portfolio. I actually took it out of the Asymmetric portfolio when they shut down Cruise. That was where I thought there was real asymmetric potential. But it's actually performed pretty well. And I think that's going to continue in 2026. Crocs is another one of these value companies that I just can't get over. Price to earnings multiple on a forward basis is just 7.7. Price to free cash flow is just 6. They are paying down debt. They are buying back stock. When you look at their business, Crocs is just going nowhere. Now let's break this down to their segments because this is where something like these segments and KPIs is really important. let's compare the Crocs brand and the Hey Dude brand. This has been the real challenge for Crocs, is that the Hey Dude brand has been in decline while Crocs has actually been growing over the past couple of years. We're going to actually learn a lot in the fourth quarter. They had some pretty weak guidance for the fourth quarter. That's why shares were down a little bit. But I think things probably weren't quite as bad from a consumer standpoint as a lot of people thought, including Crocs management. That could mean that they sold through a lot of their inventory. But given the valuation, I think that Crocs is just too cheap to pass up today. That's why it'll outperform in 2026. Two blockchain stocks to end things here. Coinbase, you can see this is one of the crazy volatile stocks over the past 5 years. But shares were trading up over $400 per share earlier in 2025. We're now down at about $250. That's given us a pretty compelling valuation. See, the price earnings multiple on a trailing basis is just 20. Obviously, those estimates for the next year, not quite as high because of trading volume coming down on crypto. That's why when crypto prices come down, typically volatility comes down as well. That hurts Coinbase's business. But I'm not really interested in Coinbase because of their trading business. I'm interested in Coinbase for everything else. Stablecoins, blockchain rewards, interest and finance fees, custodial fees, other subscription and services revenue. Let's put all of those together and you can see that these businesses are growing like crazy. This is the disruption of the traditional finance business at work. This is building the base blockchain. This is the Coinbase wallet. This is the USDC stablecoin. It's all of that stuff that happens behind the scenes. I think in 2026, we're really going to see much more adoption of the blockchain and in particular stablecoins, probably going to be invisible to you and I as users. But Coinbase is one of the companies that's going to make this much more efficient. Think about replacing things like a 3% credit card fee, which you may not pay for, but a merchant does, replacing that with just a stablecoin transfer. Instead of taking 2 or 3 days for you to get your money, you get your money more immediately, and it's basically zero cost to make that transaction on the blockchain. Those are the kind of opportunities you have. They're moving into things like stock trading. More assets are moving onto the blockchain. I think all of these are going to be tailwinds for Coinbase. That's why this is one of the stocks I'm most excited to add early in 2026. Another one along those same lines just came public was Figure Technology Solutions, a little under a $9 billion market cap for this company. This is going to be much more of a platform company. So they're going to be connecting borrowers with companies who are able to lend money on the blockchain. And that's the real disruption there, is that it's more efficient to find capital that way than it is to go through traditional mortgages in particular. That's where they're starting, is HELOC loans. But we're going to see them move into everything from crypto loans to stock trading, personal loans, business loans. All of these things can be done more efficiently on the blockchain. Figure is one of the companies that's building that infrastructure. It's still young. It's still pretty expensive. Enterprise value to sales is 21.5. But look at the growth rate for their revenue. This is December 2023. They had $210 million in revenue in the last 12 months, $431 million in revenue. So again, young company, a little bit higher risk. I'd love to see some sort of downturn where we have companies like this sell off. And we could see that in 2026. But long term, I think Figure is one of these companies that's going to outperform the market. Now, a reminder, if you want more from me, check out Asymmetric Investing, my newsletter. There's a link on the screen and a link in the show notes. That's where you're going to get all of my research. Premium subscribers also get the Asymmetric portfolio. So that's my market beating portfolio. You're going to get every trade before I make it. I buy stocks once a month, make it very simple and show you exactly what I'm doing, showing you exactly how to beat the market. It's not as hard as it seems if you're buying asymmetric stocks and you're just holding them over a long period of time. So trying to stack all of those advantages that we have over the market, stack them all together to beat the market. And that's exactly what I've shown how to do. So check that out if you want more from me. Don't forget to subscribe here on YouTube. Thanks for watching, everybody. See you here next time.